All righty, traders. Let's get into Tom's trading rule number 4. So what we want to talk about today is never chase the entry. There will always be another trade. So never chase the entry. There's going to be another trade around the corner. So what do I mean by chasing the entry? So chasing the entry means that a trader missed putting on a trade in which the entry price was missed. Maybe somebody has an alert service and they posted an entry and you're just getting to it on your lunch hour, and now the price has moved significantly against you, or you identified a trade but didn't get onto it in time for the price you wanted. It ran away from you, but you still want to get in, and you're going to put that trade on after the stock has moved quite a bit. So most often, the price is moving quickly away, and the cost to put a new trade on is now significantly different than was originally planned. And there's several dangers to trying to chase the entry and putting on a moving trade at a new price, or trying to hit that moving target. Number one, increased risk. Chasing the entry price is going to involve entering a new trade at a much less favorable price than originally intended. Now, obviously, if I'm trying to put on a put spread or a naked put at $12 at a certain strike, and now it's at $12.50, okay, maybe that hasn't moved a lot. But if I'm putting on something at $12 and it's now at $13.50, $14 to put on a trade on the buy side, or again, if I'm putting on a short put, maybe it's now $10 and I'm getting a lot less premium than I anticipated. Often traders are paying more for a trade or getting less in the case of selling premium, and some of the move has already happened. Again, let's say you wanted to buy NVIDIA and an at-the-money call option was maybe $17, but the stock moves up $10 in the morning, and now the option costs you $25. So maybe a 50 delta, it's moved up $10, which is basically a $5, $6 move in the option. So now do you still want to buy it at 17, which is what the original stuff, but now it costs you 25? Do you want to do that? Or again, I'm trying to sell an option at 17. The stock moved up $10, and now instead of me getting $17 worth of premium, now maybe I'm only getting 12. It's a significant move. So it increases the risk because the trade's now got a lot less potential for profit than your original trade plan, and now has a higher likelihood of incurring a loss. Another reason is missed opportunities. Focusing solely on matching the entry price of a planned trade may cause you to miss out on another potentially profitable trade. So the market's dynamic. There's always numerous trading opportunities every single day. There's a lot of opportunities out there. If you're fixated on one specific entry price on one specific trade, often you neglect other favorable setups. And if your trade moved away from you, go find one of those other more favorable setups and jump in. So if you miss an entry, let it go and just find a new trade setup, either in that stock or in something else. Another problem here is emotional decision-making. So when you're chasing trade entries, that's typically driven by emotions such as fear of missing out. So you get FOMO, or the desire to recover a missed opportunity. Now, either one of those things can happen. FOMO, someone else is jumping into a trade, you can't get into it in time, it's already moved on, and now I'm getting questions of, hey Tom, should we still enter your trade? Well, it's really up to you. It's your trading plan, but now does it still make sense? Does the original premise make sense? Or now if I'm not getting $10 in premium, I'm only getting $7. Is that gonna now hit my target? So if it was $10 in premium and the return on capital of that trade was maybe 3% in 30 days, but the new trade is only $7 in premium and I'm only getting 2% potential premium, or return on capital in 30 days, it no longer makes sense to me. If I can't get 30% annual on a trade, breaks down to about 3% a month. If I can't get my 3% a month on a trade at a minimum, I'm not going to put the trade on. So if it's moved away, you know what? Forget about it. Find something else. Don't make the emotional decision and jump in on a trade. Emotional decision-making often leads to impulsive and irrational actions, which usually results in poor trading outcomes. Chasing trades is no longer about following your plan. It's now about emotional trading. You've got to be able to pull yourself back and make logical decisions. There is always another trade. So it's try again. If you miss the initial setup, take a break, step away, then go back to work looking for other opportunities. I wouldn't even try to find another trade in that stock. Well, if I sold the $50 put for $10, which was my original trade, well, now it's moved. So should I sell the $45 put for $10? I don't know, because now, even though you might get similar premium, the trade's already moved. So now you're partially through the move, and the move only has a finite end to it. All moves end at some point. Okay, doesn't mean all stocks don't eventually all go up or something at some point, but all moves will end at some point before they reverse, and then some other move happens in that underlying. Take a break so you don't try to revenge trade a missed trade. Step away, go back to your plan, find something else to trade. When you miss a trade opportunity, it's simply better to stop trading and step away. There will always, always, always be another trade around the corner. All right, so there's my trade rule number 4. If you miss a trade, there's always another one around the corner. Don't chase the entry. If you like these rules, go ahead and click that like button, click to subscribe to this channel. Great trading out there. Good luck to everybody.